recording.
Okay. So I just hit continue, I guess. So hello, everyone. I'm Tom Ham, co-chair of the Hospitality Council. Welcome to our quarterly Hospitality Council call. I'm new to hosting Zoom, so I apologize in advance for any screw-ups. I'm happy to report that the vaccines are working, and we seem to be on our way to more normal times, including travel and tourism. We're seeing the early effects of recovery and pent-up demand. Hotels are busier, airports and airplanes are busier, and we hope that group business should follow. I believe that we're seeing the pace of recovery being a little bit faster than we had anticipated about 6 months ago. But let's turn to the real expert. We're delighted today to have Dan Lesser with us, President and CEO of LW Hospitality Advisors. Dan is a true and seasoned authority on the hospitality industry, both as an appraiser, as a counselor, and frequent panelist. So we're especially grateful for him to be on today, and as a court-appointed receiver. So Dan, thank you very much for your time, and take it away.
Thank you so much, Tom. I really appreciate that gracious introduction, and good afternoon to everybody from sunny and beautiful suburban New York. Summer has definitely come into the fore here, which is great. Thanks for joining. I actually was hoping that Tom would just keep going because he was spot on and gave half my presentation, but that's okay. It shows that it makes me feel that what I'm going to say is spot on. So thank you for that, Tom. Okay, I have a slide deck here that I'm going to go through fairly quickly. And then if you don't mind, I'd like to save questions till the end. I'll stick around as long as anybody wants. Happy to answer questions now or sometime in the future. My contact information is here to the extent you ever want to reach out to me. Happy to do a dialogue one-on-one as well. So, before we delve into the sector, I always like to sort of go through this. I think it's very important. Many people know this, but it sets a good backdrop for everything else that I'm going to say. And at the end of the day, within commercial real estate, hotels are unique animals. They're not like office buildings. They're not like shopping centers. They're not like apartment buildings, right? The mere fact that it's an operating business, right, married up with bricks and mortar real estate, and both are very intertwined, is unique, right? Daily leasing of guest rooms, with technology being what it is, average room rates or pricing of rooms literally changes by the nanosecond, which, by the way, in an up market, that's a beautiful thing, right? In a down market, it'll kill you, just like was experienced during this recent pandemic. If you think about full service hotels, they generate more than just rooms revenue, which is commonly known as heads and beds, right? They generate food and beverage revenues, recreational revenues, maybe retail space, right? And then, the skill set to generate those revenues is very different than putting heads in beds, right? The skill set to control the costs associated with those varied income streams is also, complex. So the bottom line is that, again, hotels are very, very complex assets. High fixed costs, high labor costs, highly, leveraged business, reliance on intermediaries, right? Think about hotels that are located on island locations, right? If the airlines reduce their lift for some reason, that's going to have a direct impact on lodging facilities. And the last thing I would say, again, this is just to set the backdrop about hotels and why they're different, is that you end up having many different constituents in a hotel deal, if you will, right? There's the owner, there's the debt, there's probably some equity that's invested with the owner. There's many times a management company, whether it be branded or independent. There's a license franchise affiliation. So there's all these different constituents, and many times the way the agreements are structured, not everybody is pulling in the same direction because compensation drives behavior, and it doesn't always work out that that everybody's interests are aligned. So hopefully everybody understands this. Excuse me. The sector pre-COVID was on an absolute incredible upward roll for 10 years. We were setting records in terms of demand, occupancy, average daily rate. 2018, a record. 2019, January 2020 and February 2020 were new records as well. Now, it's important to note that although the metrics were increasing, excuse me, as time was going on, those increases were decreasing, but there were increases nonetheless. And if you recall, if you're in the hotel space, in 2019, there was a lot of agita in the investment community. This is too good to be true. This can't last. There's going to be a black swan event. There was a lot of concern about that pre-COVID. Well, now we know, what that event ended up being. But the point here is that, we went from record metrics in the hotel space on the positive side to negative metrics off a cliff. I mean, it's remarkable. It's outstanding what happened. It's unprecedented. Again, if you think about other forms of real estate that have long-term creditworthy tenancies, right? Income did not go off a cliff, right? Because tenants were still theoretically responsible for their rent. The hotel sector really took it on the chin very, very badly. And here we can just see a graphical example of the numbers that were illustrated on the prior table. And, the red line on the right-hand side, very much illustrates that rapid, swift, wide, deep decline in operating metrics for hotels. Again, this all comes back to daily leasing and constant repricing of guest rooms. And we all know that, in the lending environment, there's been no shortage of defaults. There have been bankruptcies, foreclosures in all commercial real estate. But here we can see that within CMBS, hotel clearly led the pack in terms of defaults, right? It all makes sense again because of that daily leasing. So this is the bad news. The good news is that these numbers are starting to come down. The fat lady hasn't sung yet. We can talk more about that. A lot of special servicers have been very patient and probably will be so through Labor Day because the outlook is phenomenal for the summer. But I really do believe the rubber is going to meet the road right after Labor Day, and the party may very well be over, and we will see quite a number of formal defaults, foreclosures, bankruptcies, what have you, because the kicking the can down the road is, I believe, coming to an end, particularly because the economics of hotel operations are getting better by the day. So here we can see these are statistics that are indexed off of 2019, and we can see that the rebound has been fairly swift, right? No different than the decline. And annualized RevPAR, which is revenue per available room, it's the simple calculation of occupancy times ADR, that we are already halfway back to 2019 levels, which again were records. So it really, again, just illustrates the volatility of daily leasing and constant repricing of guest rooms. Now, if heaven forbid, these variants that people talk about, if that becomes a phenomenon here, we could see these numbers reverse very dramatically. So really got to be sort of aware of that. And frankly, that's part of the risk of investing in the sector. And again, this is just more statistical information showing about how occupancy and ADR are on the rebound. Well, first, the dramatic decline, unprecedented on the left-hand side here. What's really interesting, I mean, this negative number, I believe, is 80%, 80. What's interesting is that in prior downturns, whether it be the Great Financial Crisis or 9/11, RevPAR, revenue per available room, during both those occasions declined 22, 23%. And those were tremendous, oh my God moments, unprecedented, right? Well, when 80% occurred last year, obviously that made the prior downturns look like child's play. So I think this also proves the notion that everything is relative in life. I'm sure everybody's aware that there were a rash of hotel closures throughout the nation, very acutely in downtown 24/7 urban cores. We're going to talk more about hotel closures, but the sector is reopening, including downtown urban cores. We're clearly seeing that it's leisure-oriented drive-to properties that are rebounding quicker. Business travel, corporate individual travel is starting to come back. It's been a little bit sluggish. The general consensus is that after Labor Day is when it'll be back in full force. But the big missing element for the sector is the group meeting and convention business, right? So big box hotels, 1,000+ room hotels are going to be challenged for quite some time. And there are still many, many of those that are closed and probably will remain closed for the near term. So permanent closures. I think the poster child of talking about permanent closures that actually, in my humble opinion, are really not permanent closures is the property on the upper left-hand corner of the slide, the Hilton Times Square. So this is an asset that has an entrance directly on 42nd Street between 7th and 8th Avenue, right in the heart of Manhattan. If you're familiar with the property, it's about a 35-year-old box. Functionally, the way it lays out, and frankly, the location does not lend itself to conversion to an alternative use, such as residential or office. Plus, physically, the box doesn't work. And so, although it has been announced that hotel is permanently closed, I'd be very shocked if it does not reopen as a hotel at some point. When it does, in all likelihood, it will not be a Hilton affiliate. But again, I cannot see that a 35-year-old property, probably the economic life on that asset is 75 to 100 years. It's not going to sit there for 50 years vacant. That's just impossible. Now, on the other hand, the Roosevelt Hotel in New York, which straddles a city block from street to street on Madison Avenue. In total, it's about a half a city block. This is an old, functionally and physically obsolete hotel, 1,000+ rooms. Actually, nice looking on the outside. It's got that little bit of a historic flair to it, but it's reached the end of its economic life. The improvements have. The location is second to none. And Pakistani Airlines actually owns this property, and for the past 20 years, they've been talking about redeveloping the site. The markets have been such that New York has been a strong hotel market up until recently, and it's made keeping it a hotel as an interim use, viable for an extended period of time. Another hotel, the Hotel Pennsylvania, I don't see a picture of it here, in New York, across from Madison Square Garden or Penn Station. Vornado owns that, and also for 20 years they've been talking about tearing it down and redeveloping the site. Some may remember that about 15 years ago, they made an announcement that they were going to tear it down and build a new world headquarters for, at the time, Merrill Lynch. Well, the market went sideways. That deal went sideways. It never happened. And then again, the hotel market was robust enough to make the economics such that it made sense to keep running it as a hotel until it did not make sense anymore. And hence, here we are now. COVID makes it probably not a whole lot of sense to reopen that. And I would imagine at this point that hotel will be permanently closed and redeveloped with something new. The point here is, don't necessarily believe everything you hear. Rooms under construction, it really is interesting. The hotel business notoriously has a bad habit of shooting itself in the foot and, developing new properties right into a downturn where we peak in terms of new construction right at a downturn. I don't know how they managed to do that, but they do manage to do it. It's exactly what happened here as well, right? But now we are, past 15 months, right? There's a lot less hotels that are being proposed in planning, in final planning, et cetera, et cetera. I say there's a dramatic reduction. However, I will tell you, it is interesting. COVID sort of pushed over the edge lots and lots of functionally and physically obsolete hotels in America, sort of like what we just talked about. And we are going to see quite a number of assets, closed, never to reopen, not just in downtown urban cores, but in suburban locations. This is in the public domain. There's a Marriott, full-service Marriott in Farmington, Connecticut, that just traded. It's a 1981 construction Marriott. It's very functionally obsolete. It's set up in, I believe, 3 guest room wings connected to a commercial building. In 1981, that was the way these things were constructed. Today, the property, in order to maintain its Marriott affiliation, needed a significant PIP, or product improvement program. And a multifamily investor came in and bought the asset and is going to convert it to apartments, right? So think about it. 1981, 40-year economic life is kind of short, right? But it does make sense that, hotels like that can become obsolete fairly quickly. However, because of the supply that's going to be coming out, we are actually doing quite a number of feasibility studies throughout the nation for new construction. Now, keep in mind that this new construction is not breaking ground tomorrow, right? First, economic viability needs to be confirmed. Approvals need to be sought. Debt and equity need to be raised. Construction takes a minimum of 18 months in the suburbs and upwards of 36 months in downtown urban cores. So we're talking about new supply several years into the future. And here we can see that there's a dramatic rebound in the works, right? The 2020 actual, which included January and February pre-COVID, which were, again, record-setting numbers. At the end of the day, revenue per available room indexed to 2019 for the year was down 50%. And we can see that, for this year, it's expected to be down 32%. People are all excited about that. Oh, wow, it's better than 50. Again, everything's relative in life. And then, the forecast is that in 2022, revenue per available room indexed to the high watermark of 19 will be down nearly 20%. So it's going to be a little bit of a slog to get back to pre-COVID highs, which again were 2019. There are all sorts of prognosticators out there, some of whom are saying 2022, others who are saying 2027. The reality is nobody knows. Here's, I believe this is Smith Travel Research, and, they're saying 2024, 2025, and these are national averages. Very important to keep in mind that, while we talk about the hotel business nationally, the hotel business always has and always will be a neighborhood street corner business. And it's very, very sub-market driven, right? Not just market driven, but sub-market driven, right? You take an urban, location like New York, or New York metropolitan area, I should say, right? There are so many sub-markets just within Manhattan, so many sub-markets within New York City, and so many sub-markets within the MSA, right? And it's very, very sub-market driven in terms of supply and demand that really determines economics, recovery, justification for new construction. So let's segue over to the transaction activity. And some of you may know that I do a quarterly survey on major U.S. hotel trades, individual assets, $10 million or more. So these are not purchase prices that are allocated from any portfolios, because that doesn't really give you the true sort of market perception of property value. These are, again, individual assets, 10 million or more across the country. And we can see that, again, remember what I was saying, there was this agita in 2019 in the back half of it, and then going into 2020 about this is too good to be true. And we could see that in the Q1 2020 transaction data, right, which shows that the transaction environment was already slowing down. And that's that concern that I was referring to, right? The number of transactions down 23%, and the average sale price down 24%, right? And this is, again, keep in mind, quarter to quarter, does look a little bit, sort of concerning at that juncture. COVID hasn't happened yet. And here we are in Q2, right? And this is a full quarter of COVID baked in, right? This is the bottom. This is when the revenue per available room went down 80%. And these statistics are just, again, they're unprecedented. The number of transactions in Q2 2020 were down over 80% compared to the prior quarter, right? Total transaction volume down 90%. Price per key down 40%. So again, this is Q2. We're talking about, call it end of June at the latest, right? I'm always amused when downturns happen, and within days of a downturn, folks coming out saying, "Oh, hotel values are down," and pick a number, 20, 30, 40%, 50%. And I always scratch my head when that happens, because this is what I do day in and day out. My work is a hobby; it's not work, and I live and breathe the hotel market, and I scratch my head and I say to myself, "Wait a second, how do you know that?" Because I don't know that, right? We're going to see later on that over time there's transaction activity that actually proves what the movement in value ended up being. Okay, so let's just move on here to Q3, right? We can see again, dramatic decline on all metrics relative to major hotel sales, 10 million or more. Q4, more of the same. Interesting to note that in Q4, there were a slew of transactions that were sold to either municipalities or nonprofits for conversion to housing for the homeless. This is another reason why the net supply is going to change, because you have a number of assets that have been converted to alternative uses, including lots and lots of housing for the homeless, particularly in California. Interesting to note too that some of these assets are fine properties. The Sheraton in Wilmington, Delaware, the Diva in downtown San Francisco. If the economics were such that they could support continued hotel use, they would, because physically they're good properties. Also interesting to note that there was some very strong pricing paid for a lot of these assets. The one in particular that strikes me is the Embassy Suites in suburban San Jose. This asset traded to be converted for homeless housing, $450,000 per room. It's a big number. Now, granted, land value there is extremely high too, but just interesting to note about the conversion and some pretty healthy pricing paid for a number of these assets. So now let's kind of look from a high level, right? Comparing all of 19, again, which was a record, to all of 2020. Q1, again, for the most part, does not include COVID. And we can see that year over year, transaction activity, down over 50%, total transaction volume down 70%, and average sale price per key down 25%. Okay, the bottom part of the table, this is sort of good news, right? Q2 compared to Q3, we can see that transaction activity picked up quite dramatically, Q3 2020 over Q2 2020. Again, everything is relative in life, right? If COVID never happened and we saw Q3 statistics, they'd be horrific, right? But after COVID happened, they're starting, and then look at Q4, it's getting even better. And here we now are into Q1 of 2021, right? And we can see that things are still not great, right? However, there is a fair amount of activity that is going on. And there's some fairly robust pricing going on as well. We're going to talk more about why that's happening. At the end of the day, while hotel economics are slowly coming back, there's so much capital in the market. Equity money, debt money is back, chasing yield, and hotels are perceived as superior risk-adjusted investment when compared to other value-add opportunities. Lots of folks think that inflation is here for quite some time, and hotels are, think about it, they're great hedges against inflation, right? The fact that you can reprice guest rooms on a continuous basis. So I was talking a while ago about data points, and the transaction on the upper left was the first sale of an institutional quality asset post-COVID. This asset, the Harbor Place Renaissance in Baltimore, traded for $80 million. It had, in January of 2020, been in contract for $100 million. So there's an illustration of a 20% decline. Ashford Hospitality purchased 18 months before they sold it, the Embassy Suites in Manhattan. Midtown Manhattan. After 18 months, they ended up selling it for a 41% loss within 18 months. The Renaissance in Austin traded for $70 million. It was in contract also in January, I believe, or maybe December of 99 for $100 million, right? That shows a 30% decrease. The Waldorf Astoria in Chicago, I mean, what a beautiful asset from a physical perspective. That asset traded for $250,000 a room. I mean, on a per pound basis, it sounds ridiculously low. If you're familiar with the property, the finish and the fit, it's a spectacular facility. And at $250,000 a room, it sounds like an absolute bargain. Now, the economics don't justify more, but that obviously is another story. What's interesting about this $54 million trade is that about 5 years earlier, the asset sold for $113 million, I believe. So more than a 50% decline. And here we have, the Sir Francis Drake and the Lowe's Hotel up in Seattle, Hotel 1000. These hotels recently traded at significant discounts to what they were previously purchased for not that long ago. So this is now empirical evidence that shows that 20 to 50% decline in value as a possibility. Now, it's important, we're talking about, sort of broad averages. That does not mean that every hotel in America's value went down. There are some that actually stayed at parity and some that are already, in terms of value above 2019. This transaction intrigues me. Host Hotels and Resorts, the Residence Inn in Pentagon City, right outside of Washington, D.C. This is institutional grade real estate. This is not a roadside stick-built Residence Inn. Host Marriott sold it for $99 million to Blackstone in August of 2019. At that time, everybody knew about Amazon HQ2. That was fully baked at that point. Exactly a year later, in the middle of a pandemic, in September of 2020, Blackstone turned around and sold the hotel to Amazon for $148 million. That's nearly a 50% increase, or $50 million. That's kind of mind-boggling when you think about it. Like, how does that happen? But it did. The hotel has since been torn down, and Amazon is integrating the parcel into its master HQ2 plan. So again, what this points out is that not necessarily every hotel in America lost value during the pandemic. Here's one that increased in value 50%. It's interesting when lately we've had some significant sales of high quality, irreplaceable assets, and most recently this year thus far we've had 2 trades at more than $2 million a key. They're both in California, purchased by smart, sophisticated investors. Now, there's only ever been 6 trades in America greater than $2 million per room, ever. and 2 of them have already occurred this year. I think that really, speaks volumes about, investor perception. Again, these buyers are sophisticated investors. $1 million room transactions. There's been about 30 of those in total since the beginning of time. What's also interesting is that this year we've already had 2 million plus transactions per room. So this year already we've had 4 transactions, $1 million or greater, right? These 2 and the other 2 at 2 million or more. Again, purchased by sophisticated investors. Speaks volume about the sector and the perception of the sector. And here we can see that going back in time again. There have been quite a number of million plus room transactions, but it's 20 years ago it was unheard of. And the first million plus transaction to ever occur was the Mayflower Hotel in New York back in 2004. That sold for $1.1 million a key, but it sold for redevelopment. The property was torn down, and it was a land play. High-end condominiums got built on it. The first hotel sale that traded as a hotel to remain as a hotel, $1 million or more a key, was in 2006, the W in Union Square. So we can see that the notion of $1 million trades plus the trend is definitely increasing, and the trend with 2 million plus is also increasing. Again, this is high level, irreplaceable stuff. There's lots and lots of hotels in America that are not worth anywhere as close to this. Okay, I'm almost wrapping up here. So, it's interesting. The COVID pandemic has given me an opportunity to sort of look back on life and, remember calamitous moments, oh my God moments, right? Going as far back as the Cuban Missile Crisis. I think I'm giving my age away now. I vividly remember that back in those days. We had black and white TV, and after the 11 o'clock news, back when there really was news, was over, the TV shut down. I think we had 6 channels of black and white. And, the United States was literally on the verge of nuclear war with the Soviet Union over missiles being placed in Cuba, right? That was an oh my God moment. The world was not as connected at that point, right? And so I do remember my parents fretting about this and other family members. But there have been many oh my God moments, from the stock market crash to 9/11, Desert Storm. I mean, it goes on and on, right? The point of this is that, every time we end up going into these events, and while we're in them, there's all this negativity and worry and concern that the world is coming to an end. And when you look back at it over time, somehow we always come out of it, and every time we do, always bigger and better. And in the hotel space as well, every hotel downturn has been followed by an upturn that exceeded the prior upturn, every single one. And that's probably what's going to happen again here. A couple of random thoughts about what is going on in the sector. The industry is clearly in a recovery cycle. Again, tad sluggish. I'm not a big fan of the innings analogy, but it may be appropriate here. And we're probably in the top of the second inning here, so there's a lot of runway to go. New construction that was started pre-COVID and halted, for the most part, has restarted. But as we said a moment ago, projects in final planning and planning stages have declined dramatically. However, a lot of feasibility work for new stuff coming online down the line. Smart folks who've been able to hold on to their assets and have been able to tap cash have been taking advantage of the downtime to do renovations. During this downturn, not that many people have been able to do that, but if they can, they've been able to. I do find it interesting that hotel owners and investors talk about the expectation of taxes going down, real estate taxes. And I think that's somewhat of a silly assumption. Listen, everybody's entitled to probably a decrease in their assessed value, right? But for the most part, municipalities throughout the nation are, for the most part, broke, right? So, how do they come up with tax rates? They take the total of the assessed values, compare it to the budget, and they back into the tax rate, right? budgets are not going down. Property taxes, tax burdens are not going down either. So if anybody tries to convince you that, I would definitely ask for some details to support such a thesis. I spoke a little while ago about, forbearance periods are coming to an end. Again, after Labor Day, and I think through the end of this year, they're going to be, quite a lot of activity to work out problem sectors or problem issues within the sector. The industry right now is starved for labor, can't find help, no different than most other industries. It's a real challenge. I'll tell you that I am a court-appointed receiver on a portfolio of properties, and as the market has come back, I've been involved in this for about a year now. As the market has come back, we've had a number of hotels over weekend periods having enough demand to fill the house, and yet we don't have enough people to clean rooms, and so therefore we're not able to open 100% of the rooms. I mean, it's kind of mind-boggling when you think about it. There are a lot of reasons for optimism, right? The fiscal stimulus that the government has made available obviously has propped things up. I don't know how we deal with the fiscal stimulus down the line, but that's a whole nother discussion. I'm not an economist, so I wouldn't even go there. The stock market is at all-time highs. U.S. savings rates are at all-time highs. If you think about it, people's portfolios went up in value due to the stock market, and they've been home not spending money. So there's a lot of pent-up demand and a lot of pent-up cash to go out and spend. Interest rates have ticked up a tad. There's concern about inflation and additional interest rate increases, but again, everything's relative. I remember in the early 80s when prime was at 20+%, right? We are still in a very low interest rate environment and probably will be for quite some time. And that's a positive for the sector. The bottom line is, as the coronavirus continues to wane, even if there is some variant that makes it tick up again, at some point, this will all be behind us at some point. The seeds for growth are, clearly lined up for strong economic growth. We're already seeing that, and also sector growth. Hotel markets that will come back to pre-pandemic levels. How many times have we heard, this Zoom stuff, right? I mean, sure, it's great, but I think everybody sort of I know I've had enough of it. I'm sure everybody has. There's nothing like face-to-face contact. Looking at somebody in the eyes, you can see my eyes, but you can't look into my eyes. And the only way you can do that is by face. And nothing. I don't think technology is ever going to take that away in our lifetimes. I did mention that there's just an enormous amount. I've been doing this 40 years. I've never seen such a wave of capital, available money, debt, equity, for all types of structures, chasing yield, chasing commercial real estate in the United States, and then drilling down further, attracted to hotel investments for some of the reasons that we talked about. Distressed deals, there have been some. We went over some of them, and there are going to be more. There's no question about it. But there's so much money out there that for the compelling opportunities, the ones that have good stories to them, the capital is going to end up invariably bidding up these assets. And we have already started to see distressed trades that do not necessarily reflect distressed pricing. So there's a disconnect in value perception increasing because of the competitiveness relative to all the capital chasing yield, right? Separate and apart from hotel economics. One of my favorite quotes that I think has been very analogous to what we've been going through, from Winston Churchill: if you're going through hell, keep going. That's what everybody's been doing. And with that, I'd like to thank Tom and everybody else on the line for inviting me and listening to my thoughts. And I'm happy to stick around for questions. I'm also, again, happy to take individual contact from any of you. Thank you very much.
And thank you so much. That was terrific, and we really appreciate your work. I'm sure lots of people have questions. One question that I'm sure will come up, if it hasn't already, it's certainly a question that I have and a lot of people that we talk to, is, well, given all what you said, how does one actually go ahead and value hotels? general consensus seems to be, well, let's look at 2019 numbers as a, as a forecast and as a basis. Let's throw away 2020 because it was a wasted year. But as you mentioned earlier, leading up to 2019, that was a long recovery road, and normally the industry is cyclical. So, is 2019 a valid way to look at values, or, what do you do with limited price discovery today?
Well, limited price discovery, that obviously as time has gone on, as I've illustrated, as time goes on, we are getting discovery, right? Listen, 2019 was the high watermark for the sector and for many individual assets, right? We are far off 2019. Can you look to 2019 as a goal to get to in the next couple of years? Yes. Do you take 2019 and just sort of capitalize that into estimate of value? I highly doubt it, right? Listen, hotels are income producing real estate. It's all about cash flow, and more cash flow, right? So the methodology for valuing hotels has not changed at all. For the most part, it's a discounted cash flow analysis. And then, backing into implied cap rates, whether it be historical 2019, whether it be trailing 12, whether it be forward year one, stabilized year, stabilized deflated to today. I mean, you can derive 10 different cap rates out of the same analysis, depending on which level of income you're looking at. So to come back to your question, the methodology hasn't changed. It's still an income analysis. Does that answer the question?
It does. Thank you. Other folks, if you have questions, you have to unmute yourself. Carrick asked Daniel, if you had $100 million to invest right now, how would you invest it?
If I had $100 million to invest right now,
wow.
Well, I'm trying to think about, okay, so wait a second. Is the objective a single asset? Is it buying a company? How would I invest it? You know what? I think some of the smartest folks out there are Blackstone and Starwood. And they're buying Extended Stay America. I think the deal's closing today or yesterday or tomorrow, right? Blackstone's bought and sold that portfolio. I think this may be the third or fourth time. I'm not that smart, okay? So I can't tell you where to put 100 million, but I'm telling you where they're putting 100 million and more. And I'd probably follow something like that, quite frankly.
Also, what's always from a transactional standpoint, what's always the 800-pound gorilla in the room is the question of PIPs, product improvement plans, that the brands require with a change of ownership. Given the environment that we're in now with receiverships and special servicing and all of that, where do you see the brands coming down as far as requiring a CapEx for PIPs and renovations?
Oh, as things are getting better, they are definitely forcing the issue. There's no question about that. And it's always a tug of war and a push and pull, right? It's even more so now, right? In terms of some assets that I'm involved in, and brand coming back saying, hey, we want you to reinstate daily cleaning for guest rooms, right? I mean, there are some hotel companies that are talking about doing more like the airline model, right? Where you'll pay for the room, right? If you want your room clean, that's fine. It's going to be opt-in, and there'll be a cost associated with it. That's what some hotel companies are talking about, right? Who ends up doing that, if anybody? I don't know, right? It is interesting that the airlines have been doing this forever, right? The airlines, whenever this topic has come up, people in the hotel space, operators say, well, you can't do that. We're a service-oriented business, hospitable. But I'm like, yeah, I get that. But if you think about it, so are the airlines, right? And obviously they don't care about service; they care about economics. So it really depends on what your vantage point is. But yeah, I'm getting pressure from a brand on a particular branded property that I'm involved with to bring cleaning back to each room. And there's a pushback because the economics just don't justify it at this point.
Right, right. I wonder if it isn't, perhaps a little bit like the business with the towels, where they used to replace the towels every day, but there'd be a sign up in the room saying, well, you don't really need to replace the towels, and throw them in the tub if you want them replaced. Otherwise, we're just going to hang them up again. I stayed at an upscale hotel, and there was a note there that they were not going to clean the room during our 2-day stay, but if we wanted to, they would do it. They were charging enough anyway. They didn't need to charge more for that. And I think that may be one way that it goes. Bob Pliska says, how many conversations from hotels to other assets? Whoops, I lost it. Andrew, can you see that question?
I cannot know.
Here I have it, Tom. You said approximately how many conversions from hotels to other asset classes are occurring or have occurred due to the pandemic?
It's a good question. I don't know the specific number. I will tell you, it is obviously very market specific. I don't know the answer to that question. I could find out if you want to send me an email. I believe Smith STR might have that data.
Certainly there have been quite a number of them. And as you say, market specific, in Stamford, Connecticut, which is where I'm based, we have a variety of hotels, and the ones that have done the best through this have been the economy hotels, because you've had construction crews in there, and you've had basically homeless people that couldn't live in a shelter because of proximity, no social distancing, so they were temporarily moved into some floors of economy. You had the 16-story Marriott hotel that was basically operating 2 stories of guest rooms, and as you mentioned, they were running on kind of a skeleton crew kind of basis, and then when 150 kids showed up for an event, they really had to scramble to find people to service the guest rooms. So we're seeing
that's an interesting property, the Marriott in Stamford. That was originally built as a 300-room facility. Right. Then the market became such that it justified an addition of another 200 rooms, right? And here we are today. I don't know, how old is it, 35, 40 years old, something like that. That box is obsolete. And I know that there's been lots of talk about, okay, what do we do with this? It's too big.
Well, it may or may not be by the way, the box is actually a pile of boxes because it was constructed that way as modular construction. It's also in an area where there's a water issue underneath it, so it does get jacked up a little bit each year. But countering that, we had the Sheraton Hotel, and the Sheraton closed permanently, and it's been sold to someone that is going to make that into housing. So we'll see what happens there. Although I did see towels and linens being delivered to that hotel a week or so ago, so I'm a little suspect.
That hotel might have been ill-conceived from day one.
It was. There was a rush to overbuild in town. Everybody wanted to preempt the other with a big box, and there were too many big boxes. We have the Crown Plaza, which is currently closed, but it had an odd wing, and they made that into a Holiday Inn Express. So the Holiday Inn Express is functioning, the Crown Plaza portion isn't. Brian Resendez has been very successful in selling a lot of hotels in his neck of the woods for conversion to housing. So we're seeing that. And I remember lots of industry experts saying, well, the problem with the industry is it's under demolished. Well, I think we're seeing demolition and conversion. So
Absolutely.
that may be a good thing. Other questions, Andrew? I think a couple of things have popped up, but they disappeared off my screen before I could read them.
Yeah, so just to let everybody know too, the new Zoom platform, if you look at your Zoom screen all the way to the lower left, you can unmute. It might be a little more conversational than chat, but I'll go down the list here. Bill Lyons had a question. Thank you. My question is, I work in a seasonal Northeast coastal market. Currently, there is a large optimism as properties are full, but can you comment again on post-Labor Day thoughts? Many smaller owners seem to tell me, check with me in the fall, but I think we need to talk now their future.
Well, probably the markets that you're referring to are drive-to leisure markets, right? Let's face it, the summer is already off to a phenomenal start. This summer will be record-breaking in terms of travel, entertainment, people staying in hotels. Once Labor Day passes and people go back to work, it really depends upon what the drivers are within a sub-market, right? If it's all leisure-based, I think it's safe to assume that as we go into the fall and the winter and next spring, that these drive-to leisure markets in the Northeast, will do fairly well, over the weekends, right? Depending upon how much core corporate business there is within a submarket, will really dictate how much, if any, corporate business there is to achieve during the week, if you will. Yeah, I hope that answers the question.
I mean, from what I'm seeing, certainly the airports are busier. A lot of it has been leisure, but corporate is starting to pick up. There are more requirements that people come to the office at least a few days a week, and where travel is an essential part of the business, there seems to be, a requirement that people travel or do their best to do that. And, with vaccinations and trying to be careful, that seems to be working fairly well for now. Hopefully we won't have another spreader event that would put the kibosh on that trend.
I think it may be worthwhile noting, and I hope nobody's offended, but the Hunter Hotel Conference was last month in Atlanta, and I actually went down there, and it was really remarkable. There were 1,200 not only registered folks; everybody who registered for the most part showed up, and I was told that there were less than 100 who signed on for virtual connectivity. Right. So think about that. 1,200 people showed up and in our business, right? And less than 100, did it through Zoom. It was quite interesting when I first got there. Everybody had a mask on, and within 6 short hours, nobody had a mask on. The other thing that I found very remarkable too, and I'm seeing it all over the place, is everybody is shaking hands again. I don't know. Interesting. When you see me, do me a favor, just give me the elbow, okay? And don't be offended if I don't shake your hand. I was born a germaphobe, so COVID was right down my strike zone. It only took me 60 years to prove to my family that I'm crazy, but not as crazy as they thought I was.
Very good. Andrew, there was a comment that people are not able to unmute themselves. Is there anything you can do about that?
Yeah, and I commented to Carrick, thanks for pointing that out. I thought I had checked it, but I had unchecked the box there. So people should be able to unmute themselves I know we're coming up on the hour. We're about 4 minutes to the hour. So you should be able to unmute yourselves or just, write a chat, either one, but we'll be watching.
Daniel, any comment on amenity offerings in hotels that had changed during COVID and maybe won't go back to it used to be due to a newfound best practice?
Amenity changes.
Yeah.
Newfound best practices probably limit the amenities because they all cost money. Listen, pre-COVID, we saw that for the most part, those little bottles of shampoo and conditioner and soap, hotel companies are realizing, terrific savings by buying in bulk and presenting in bulk within the guest rooms. I think every TV remote is now covered in some sort of a sanitary wrap. Chocolate on the bed is not there anymore. I don't think you're going to necessarily see an expansion of amenities. Quite frankly, the sector is looking for ways to save money, not spend money. And listen, you know what? Invariably, what happens is as the market gets better, people have short memories. Everybody does, right? And then that amenity creep starts all over again.
All right, a question for you on, where you see things going from the receivership and servicing standpoint. There's, lots and lots of hotels that are, in servicing or in receivership. And, for the most part, very little is happening. Servicers don't want to sell at the bottom of the market. And of course, distress didn't really present itself for investors early on as many had expected. So there's capital lined up. But where do you see receiverships and servicing going in terms of, becoming actual trades of hotel properties down the line?
So it's interesting. Thank you for that question. Right after COVID, obviously, the special servicers and frankly all lenders were just inundated with assets that just couldn't pay their debt, and they were overwhelmed, quite frankly, and just didn't. They couldn't get their arms around what everything that was coming in as quickly as it was coming in. Lots and lots of hotels were bleeding cash if they were staying open, and even if they were shut permanently, there's a cost associated with shutting down, reopening, and securing a facility during a shutdown as well. So that's not a free option. And if you think about it, a lender doesn't really want to take back a hotel where there's cash burn, right? So, it is interesting that there are no shortage of assets that are in special servicing on the CMBS side, but there really are not as many receiverships as you would think. Again, because the lenders have been hesitant to well, first of all, getting their arms around what they have, right? Attacking all the problems and figuring them out. Negotiating takes a while. Documenting takes a while. And as time has gone on, the sector's getting better, right? The economics are getting better. That's why I believe after Labor Day, when the summer party is over, the rubber's going to meet the road, and you're going to see deals that are, in default, the remedies being cured for, right? And receivers. I think you're going to see more receiverships bubble up after Labor Day. By Q4, I think we're going to see it in earnest. And typically once it ends up in receivership, I think there's a good chance you're going to see some sort of an exit, some sort of capital event to either restructure or sell. But something, it can't stay in receivership forever. It can't stay in special servicing forever. So I think you're going to see that in earnest Q4 and then Q1 of next year. I think you're going to see a lot more of that activity.
Great. Well, thank you so much. I think we've used up all our time, but really appreciate your presentation today and
Thank you.
all your thoughtful comments. Really wonderful. If anyone has, further questions or comments, you can direct them directly to Dan. His information's on the screen. Alternatively, you can send them to me and I'll forward them on. So.
And
thank you
Tom,
so
I
much.
will send you a PDF of the presentation, and feel free to circulate it.
Great. Thank you very much. We will take care of that. Thank you all, and have a good quarter. And I think we can look forward to transactions later on in the year. So get ready. Thank you.
Buckle up.
All right.
Thank you.